Over the last couple of years, I've made multiple six figures with trading and more importantly, helped thousands of people successfully trade. So today, I'm gonna condense my 8 years of experience into a straightforward guide that you can use to start making money in the stock market within the next 7 days. And it all starts with finding an undervalued stock. Look, the new hot stocks are always changing every single year. But if you can understand the 3 principles of an undervalued stock, you'll be able to spot stocks everywhere you look. This is the difference between beginners and experts. So here are the 3 principles of undervalued stocks. The first key factor you need to consider when evaluating a stock: it must have a competitive advantage, or what we often call a moat. So here's what you're really looking for: a company with something unique that keeps competitors at arm's length. That could be a powerful brand that everyone recognizes, proprietary technology no one else can replicate, high switching costs that make it tough for customers to leave, or even exclusive patents that block others from entering the market. Why does this matter so much? Well, if you can spot a stock with a durable moat, you're likely looking at a company that can consistently generate returns over the long term. That protective barrier insulates them from a lot of the typical competitive pressure and even economic downturns. In other words, they've got some built-in resilience that should keep them performing well, even when times get tough. Now, here's a critical insight. You don't want to chase purely speculative plays, especially if you're starting out. Instead, look for proven businesses with a solid track record and a clearly defined moat. That way, you're not just hoping that they'll succeed, you're leveraging the fact that they've already succeeded. You're basically investing in a blueprint that's worked before, and that gives you a whole lot more confidence in your future returns. Find companies that have a real moat, something that sets them apart and makes it hard for competitors to break in. This is one of the best ways to reduce your risk and tap into long-term gains. Moving on to our second principle, and this one is a big deal. The company must have a positive free cash flow. Now, what does that actually mean? Basically, you're looking for a business that generates enough money to cover its operating costs and capital expenditures, while still having cash left over. That surplus can then be funneled into growth initiatives, dividends, or even share buybacks, which all translate into real value for shareholders. Why is it so critical? Positive free cash flow is a rock-solid indicator that a company's core operations are both profitable and self-sustaining. That means they're more likely to weather economic storms and less likely to rely on outside financing just to keep the lights on. Here's a key insight: be aware of companies that boast massive revenue growth but constantly burn through cash. It's a huge red flag if they can't actually hold on to any of their earnings. Instead, look for those with a proven track record of generating surplus cash, because that financial cushion allows them to fund new products, make strategic acquisitions, or handle any unexpected challenges without going into panic mode. And remember, we're talking about long-term value here. A company with a healthy cash flow isn't just surviving, it's setting itself up to thrive in the future. Now, the next principle ties directly into how this cash flow is managed: having a good management team. You might find a business that's raking in the money, but without strong leadership to direct those funds wisely, that advantage can slip away fast. So let's talk about why solid leadership matters just as much as the numbers. It sounds obvious, right? But you'd be surprised how many people overlook the importance of leadership when evaluating a company. Here's what you really need to pay attention to: executives with a proven track record, people who've actually delivered on their promises, allocated capital efficiently, and driven sustainable growth in the past. Why does this matter so much? A company's leadership fundamentally steers its direction and performance. A solid management team can navigate shifting market conditions, foster innovation, and guide the business toward high return opportunities. In other words, they create real value for shareholders. Here's a key insight: stay away from businesses led by teams with a history of poor decision-making or vague communication. That's a recipe for confusion and stalled growth. Instead, you want leadership that consistently shows integrity, strategic thinking, and a clear vision for profitable expansion. When the people at the top know what they're doing and have a proven track record, you're investing in more than just a company. You're investing in a stable, well-guided future. So remember, even if a company looks great on paper, weak leadership can derail everything. Seek out those executives who walk the walk and can turn a promising idea into a long-term success story. After all, great management can be the difference between just another stock and your next big winner. So now let's go onto the computer and I can show you guys how to identify undervalued stocks. So I'm going to show you guys how to evaluate undervalued evaluate stocks. One, through the old antiquated method where you're just purely essentially looking at numbers, and the new method where you are using MarketDash. So with the old method, I'm just hopping onto Yahoo Finance. Typical Yahoo Finance here, I can see the income statement. You see numbers like the total revenue trailing 12 months in terms of the past prior quarters, right? 31 mil, 29 mil, 27 mil. You're seeing other financial metrics such as the operating income, you're seeing the earnings per share, you're seeing the EBITDA, all these different financial metrics just like this. You can go over the balance sheet, purely just numbers, right? You're looking at the assets, its liabilities, its debts, those things, right? The shares outstanding, things like that. You're looking at the free cash flow right here. This is the trailing 12 months, purely numbers, right? Very hard to digest, really difficult to sort of interpret a lot of these financial data unless you sort of provide your own graphical representations. Here with MarketDash, I can clearly see on the overview screen what this company is about. PayPal right here enables digital payments on behalf of merchants and consumers worldwide. I get to see the company's financial metrics off the bat, and I get to see it through an illustration. I get to see the price to earnings, its graphical representation right here. And rather than just looking at the numbers quarter over quarter, I actually get to see how it relates to in a visual format in the past 5 years. So you can see here, it's literally trading at historical lows. So I understand when I'm buying this company, I'm buying a company at a cheap discount or a cheap valuation compared to its history, right? Historical low price relative to its earnings. I get to see the revenue now, right? Instead of looking at numbers, I get to see the graphical representation over the trailing 12 months. I get to see as a 25 mil in quarter 4 2021, and then it increased to 25 mil in quarter 1 2022. But you can see its history, very consistent revenue in the trailing 12 months. Same thing for the free cash flow, right? A lot easier to interpret this information than if you just go to something like Yahoo Finance looking at numbers like this. Very, very difficult to sort of understand. In addition, I get to see other financial metrics such as this profitability metrics like return on assets. You get to see if it's trailing higher than the median, equal to the median, or lower to median, and you get to see that graphical representation once again and see how that compares to history. And then you get to see a balance sheet decomposition. Rather than looking at the company's numbers in terms of the assets and liabilities, we actually get to see the illustration, the full breakdown in a pie chart format. The receivables, the cash, the non-current assets, the investments and advances, the goodwill, and so forth, right? Same thing for the liabilities. Rather than just looking at the liabilities without any breakdown of it, we get to actually see the pie chart, the payables and accrued expenses, other non-current liabilities, long-term debt, and capital lease obligations. Furthermore, we get to see the shares outstanding here. You get to see if this company is diluting its shareholders or is it reducing the share count? Are they having a share buyback program? So in this scenario, we get to see clearly the company is on a massive share buyback program right now. You get to see the year-over-year growth. Same thing for the free cash flow in the trailing 12 months. On top of that, we actually get to see the intrinsic value. So how much is this company worth if you were purely looking at the fundamentals, no market sentiment, just off of its numbers alone? This company is essentially worth $108.57 and currently trading at $86.86, right? So undervalued by 25%. And I get to actually see where it is, how far away is it in relation to its current price. And lastly, we have the Wall Street estimates. You get to observe analyst ratings in terms of buys, holds, and sells. In this scenario, we see 4 buys, 9 holds, no sells. You see an average price target of $84, a highest price target of $95, and a lowest price target of $71. And we get to see what are the exact downside targets and an actual representation of where these average price targets are to its current price. So there you have it. Those are the 2 methods to evaluate undervalued stocks. The antiquated way through Yahoo Finance, where you're purely looking at income statements, balance sheets, cash flows. You're just looking at these numbers, not really understanding any of these numbers, how they relate to the trailing 12 months or even in history. No real indication of whether this company is a buy or sell. It's pretty much up to your interpretation of where these earnings are and your expertise. And then we have MarketDash, where you get a graphical representation of all these numbers. You can really understand where these numbers are in relation to history. You get to see
see other information like its competitive advantage, the risks, the intrinsic value, as well as the Wall Street estimates here.
So look, remember when it comes to trading stocks, consistency is everything. Avoid chasing losses because trying to recoup a bad trade by going all in on the next one usually leads to more trouble. Instead, follow a clear set of rules, stick to your strategy, and refine it as you learn. Patience is just as crucial. Sometimes the market won't offer a solid setup for days, and that's okay. It's better to wait for a high probability trade than to force something mediocre. Finally, discipline keeps your emotions in check. It stops you from panicking after a loss or bailing on a winning position too soon. One breakout trade really can change your trading journey, but only if you allow yourself the time and space to find it. Stick to your plan, manage your risk, and keep a cool head, even in the most volatile conditions. All right, everyone, that's a wrap for today's video. Before you log off, here's your action step. Take everything you've learned and start applying it to your trading immediately. There's no better way to build momentum than by putting these strategies into practice. If we ever run into each other, whether online or offline, tell me how your trading journey is going. I'd love to hear success stories. As for the future, I have bigger, better content in the pipeline that you won't want to miss. So make sure you're subscribed and have notifications turned on. Remember, the best is yet to come, so stay focused, keep pushing forward, and I'll see you in the next one.